go. Okay. Oh, that's yours.
All right. Well, thank you, Tamara. This is Larry DeBoer, a professor in the Agricultural Economics Department here at Purdue and an extension specialist in state and local government policy. And today, as you see, we're going to be talking about local income taxes. And I'm kind of tickled to say that I thought up that title just a couple of days ago, Shedding Light on Lit, Indiana's Local Income Taxes, here on June 7th, 2018. We do these on local governments about 3 times a year, and happy to have all of you listening in here on this warming summer day. I think we're going to hit, at least here in West Lafayette, we're going to hit 90 and above today. Today we're going to talk about several aspects of the local income taxes here in Indiana. We're going to look at the income tax structure, and I thought that would help, but I guess not. We're going to look at the income tax structure. We're going to look at rates and revenues. We're going to look at the distribution of the collections of local income taxes and how the state budget agency does that, and look at the situation with balances in each county's account. And we're also going to look at property tax relief. And so let's get started then with local income tax structure. And I need to have the screen over here, right? There we go. Local income tax structure, and Tamara is going to be talking about that.
Okay, so we were debating how far back we had to go to talk about local income taxes. Historically, we've gone back to the 70s, but I think today, now that we've been in this new system for a couple of years, we're going to just start with the new system itself. So if you remember, in 2015, Public Law 243 was signed, and we simplified all of the acronyms, the gang of local option income tax acronyms that we had in the past into LIT. So one local income tax with the acronym LIT. And so this really helped to end the debate over COIT versus COIT or CEDIT versus EDIT. And it also helped to make things a little bit more transparent and less confusing, hopefully, for people. Of course, we can't get rid of everything from the old system. So one of the things that prevails is that adopting body. And so you may remember that the adopting body depends on whether your county first adopted CAGIT or COIT. And so counties that were, as a nod to Prince, formerly known as CAGIT counties, the adopting body is the county council. For those that were formerly known as COIT counties or COIT counties, that would now be the local income tax council. It used to be called the county option income tax council, so the COIT council. But now it does have that new acronym, local income tax council. And so this can matter because that would be both county representatives and city and town representatives. And so it does kind of vary on who has the power to adopt or change the local income tax. There were a few minor changes to the local income tax as it went into effect, and DLGF worked really hard to figure out how our old system rates fit into the new system, but it finally went into effect in 2017. And so now we have a year and a half under our belt with the new system, and which means that we get to look at some data today.
Yes,
and
trends.
Yes.
2 years, we can do a trend.
Very exciting. So this is what it looked like. This was the new local income tax. I say was because we've already made a change to it this past year, and I'll show you that here in a little bit. But basically, it was divided into, local income taxes were divided into 3 different buckets. We had property tax relief, expenditures, and special purposes. Special purposes we can kind of get out of the way right away. These were things that were set especially for legislature. So they only occur in certain counties when legislation has been passed by the Indiana General Assembly, giving that specific county permission to adopt a special purpose local income tax. The other 2 buckets, the property tax relief and the expenditures, I'm looking, somebody said we had no sound. You want to look at that while I keep going? Okay, I think it's limited. And so the other 2 buckets are available for everybody, property tax relief and expenditures. For property tax relief, that it has a maximum rate of 1.25%, and that revenue is used to reduce property tax bills, so it shows up as tax bill credits on bills. We do know that sometimes that also means increased revenue for local governments when many of the property taxpayers are at their caps. And so it's meant to be property tax relief, but sometimes it does replace an unfunded credit, the tax cap credits, with a funded credit, the property tax relief LIT. That gets distributed to all local units based on the credits that are given on the property tax bills. So it's a little bit different than the expenditure rate in that way. The expenditure rate, you originally had 3 different categories that you could choose from in the expenditure rate. And the first one, the total rate for expenditures could not exceed 2.5% for 91 counties, 2.75% for Marion. Which, just to note, that means that really the maximum local or LIT rate is 3.75%. For most of the state, 4% for Marion County. And we don't have anybody at that maximum, although we do have some over that 3% rate, and we'll see those in just a moment. Under expenditures, there were originally 3 categories, the first one being public safety. You may remember the old public safety LOIT. LOIT was at a 0.25 one quarter of 1% maximum, and so we still see a lot of those, but now you can change that allocation if you choose. It just has to come under that maximum cap for expenditures. This was used for revenue that's supposed to be used for public safety functions, so thinking about jails, policing, fire protection, things like that. It is distributed to counties, cities, and towns, but the adopting body can choose for that to go to other units as well. Those other units would mostly be considered townships that are providing fire protection. But most often it just goes to the counties, cities, and towns. The economic development rate can be used for added revenue for economic development projects, and that also just gets distributed to counties, cities, and towns. And you do have to have an economic development plan for that to adopt that rate. Certified shares, which is also an old terminology that we've kept, but really it just means general spending, is just added revenue for general purposes, and this goes to all civil taxing units. So this would be the portion of the LIT rate that libraries and townships and other special districts see. It does not, however, go to schools. And so that gives us our 3 different buckets with our sub-buckets under expenditures. So we've simplified, and I'm not able to move forward. There we go. We simplified things, we made things easier, and that lasted for a year. 1 year. And so House Enrolled Act 1263, which actually was signed by the governor March 21st of this year, and is Public Law 184, gives that adopting body the opportunity to impose a tax rate for correctional facilities and rehabilitation facilities, aka jails, county jails, and under that expenditure category. And that tax rate has its own cap to make things more complicated. None of the other subcategories have their own cap, but this one does, and that cap, it cannot exceed 0.2%. And so we know the reason is this is going to go directly to counties. It's meant to fund county jails, and so that cap is likely there so that the county doesn't take over the entire expenditure rate, not that they necessarily would.
Since that rate is part of the full expenditure cap, the county, if there was no limit, could basically gobble up the whole cap, and not that they would, but they could, and no, they can't because there's a cap on that particular rate, but that does make it different from any of the other expenditure rates.
It does. It makes the system just a little more complicated. So I think about this as the local income tax kind of as my kitchen counter. Like, you clean it all off and get it simplified, and it's great, and then you just start adding stuff back on. So I think Representative Thompson originally introduced this bill that simplified things, and I've said that I think his granddaughter, which I don't think he even has a granddaughter, will come back here in 30 years and simplify it all again, clean off the counter for us. So it's important to note that one county has officially adopted this new county jail rate, and that is DeKalb County. The bill was actually labeled county jail, or named county jail issues, and so there was also a host of other special rates that were included in there. Fulton, Jennings, Randolph, Tipton, and Union counties received special rates, or the ability to adopt special rates for county jails and courthouse construction and renovation and operation in that bill as well. And, you know, this has happened before with the innkeeper's tax, was originally special legislation, and enough people wanted to adopt it that eventually the legislature made that an option for counties. And so you have to wonder, will we see less special rates in the future from the legislature, because typically those have been for jails, and so counties will at least have this option before coming to the legislature for special legislation.
It'd be interesting to see as well, and this has happened with other sorts of local legislation, if a county does go to the legislature saying, could we have special legislation for a county jail, maybe the first thing they'll ask you is, have you used the option we've already given you? And so in a sense, it's an opportunity for local governments not have to go for special legislation, but in a sense it's a block on going for special legislation because now there is a county option.
So I think that the other thing is we are seeing jail issues. There's more inmates that are, DOC is requiring those to stay in the county jails for longer. And with those funding issues, counties are looking for a way to pay for that. And so we have referenda every election, and the only two that have not been for schools have been for county jail projects. So we just had one this last May, the primary for Hancock County that narrowly lost. So I would expect for us to maybe see Hancock County adopt this next.
The coverage of that option did say repeatedly, even if the referendum doesn't pass, that doesn't mean that the corrections project is dead. So one expects they'll be looking for other options.
Yes, although funding a jail is not necessarily glamorous, it's one of those necessary county functions, and so we expect to see that funded one way or the other. So how this changes our chart is we add county jails to the expenditure list, so that's a fourth sub-option under expenditures. And you can see that under the maximum rate, it has its own maximum rate under the 2.5% cap for the expenditure rate. So 0.2% can be used towards county jails. I'd also, just to think back to the adopting body, in some counties formerly known as COIT, there's a local income tax council that's adopting. In the other counties, it's the county council. So you can see the county council, or I wonder as we go forward, if we'll see the county council counties adopt this rate more frequently than those that have a lit council with more of a variety of representatives and sometimes under city control.
Right.
So that brings us up to date on the structure of lit. Let's look at what's happened over the last couple of years.
Okay, so I'm going to take over the microphone here for a while and talk about rates and changes, and this is my opportunity to crunch some numbers. One thing I like to say about myself is I'm the kid who likes the back of the baseball card better than the front of the baseball card, and so anytime there are numbers to crunch, I'm in there getting my fingers dirty with, electronically speaking, virtually dirty with the numbers. Here's a rather busy chart, but I'll talk about it and I hope to make it clear. What I did was to add up all of the lit revenue, and you can calculate the taxable income for each county by dividing the lit revenue that's collected or at least distributed by the average rate, and so you get taxable income. as a result. And then if you add up taxable income and add up lit revenue and divide the revenue by the taxable income, you can get the average rate, the weighted average rate for the entire state. And here they are for 5 years, 2015 through the preliminary estimated numbers that the budget agency has just posted for 2019 on June 1st. Last week, on Friday, they posted the numbers, preliminary numbers, estimated numbers for the local income taxes for all the counties. So we see the number there. And we see the growth rates that have happened since 2015. And if you take a look at the far right there, the local income tax revenue, you can see 4.7% in 2016, then 8.8, 7.2, and 8.4. So local income tax revenue has been growing pretty rapidly, quite a bit more rapidly than property tax revenue has been growing since 2016. Now, if you split that out by what part has been increases in income, taxable income, and what part has been increases in the average rate by all the counties, you can see in 2 out of the 3 years, or at least in 2017 and 16, the increase has been mainly in taxable income. 3.2% of the 4.7 was taxable income in 2016, and 7.3% of the 8.8 was taxable income increases in 2017. So the average rate increase in the mid 1% range, 1.4 and 1.3. However, in 2018, not only did the taxable income increase slow down, only a 2.3% increase in 2018, but the average rate went up more. So that's 4.9%. Now, 2018 was the first full year there of the new lit structure, and so one wonders that whether that new flexibility, especially on the expenditure side, whether that new flexibility that the new structure provides caused a blip increase in the average rate. It might be a blip. I suppose it's possible it could be a trend as well. Perhaps the new structure is so much more flexible that we will see more increases in county income tax rates in the future. I kind of suspect a blip rather than a trend, but we'll see. Now, in 2019, this is a preliminary number, an estimated number that the budget agency has put out for taxable income. There's only one rate change incorporated in that, and that's DeKalb's adoption of the new corrections rate. But the other rates, I think, are still to come. And that means that the lit revenue number that we see there is preliminary. The adoptions and final adoptions of local income tax rates, you've got until August, I think, is that right, Tamara, to adopt those rates?
Yeah, so lit rates can be adopted or changed through August 31st to go into effect October 1st for collections, or October 31st to go into effect for January 1st.
Right.
So any sort of allocation changes or changes property tax credits would occur for pay 2019.
Right. So the lit revenue number we have here that's $2.6 billion, these numbers in thousands, is the current estimate for what it will be in 2019, but we've got opportunities through basically the end of October to change the rates, and I think almost certainly we will see some rate changes in the coming months. It'll be interesting to watch that. The report that we'll see now, the budget agency will put out a report, and it's due early October, but then again, there are revisions even after that. There can also be revisions in that taxable income and lit revenue numbers from another source. That taxable income number is effectively collections of income taxes for the counties for state fiscal year 2018, which runs from July 2017 through June 2018. This number was, the revenue number here was estimated as of June 1st, and so there's actually another month of collections that could possibly arrive till the end of the fiscal year. And so we've still got 3 weeks to run in the current fiscal year. So we'll probably see some adjustments there as well. But so as you see, rather big increase in the rates in 2018, and then a very substantial increase in taxable income in 2019. So taxpayers had a pretty good year in fiscal 2018, and that money will be distributed to local governments in 2019. Now here's some statistics about the County rates, so you can see what the variety of rates is out there. So these are the total rates, and there's your average rate of 1.53%. The median rate, though, is 1.73%, and what the median rate is half of the counties have rates above that, 1.73, and half the counties have rates below 1.73. Now, the average rate of 1.53% is a weighted average, means it it adds up all the revenues and all the taxable income and calculates the rate from that. And that means that rate is dominated by the big counties. You know, Marion County is a very large share of the total state, and if you add in Allen and Hamilton and Lake and the other really big ones, they'll have an outsized influence on the average rate. And because the average is lower than the median, what it means is that the bigger counties, on average, have smaller, lower lit rates than the smaller counties do. The most common rate is 1%. Now, there's a wide variety of different rates out there, and the fact that the most common is 1% may not be that significant, but you know, that's probably a legacy of the original limits that were put on the Cadgett and Coit rates when they were established in the 70s and 80s. 1% was kind of the standard. So there are more counties with a 1% rate than any other kind of rate. Maximum rate, 3.38%. So there are a couple of counties out there where the local income tax rate actually exceeds the state income tax rate. The state rate, 3.23%, and we've got a maximum rate of 3.38. And we've still got some counties with rates less than 1%, and the lowest is 0.35%. Below that on this chart, you see the percentiles, and right in the middle of there, the 50th percentile is that median rate of 1.73. And so, as I said, half the counties have rates lower than that, and half the counties have rates higher than that. But the other percentiles up there will give you an opportunity to take your own total rate and see where do we rank among all of the counties in the state. If you've got a rate at 1% or less, you are among the 10% lowest counties. So 9 or 10 counties have rates at 1% or lower. So very rare now that we have income tax rates, local income tax rates, less than 1%. On the other hand, if you've got a rate above 2.5%, that puts you in the top 9. So that would be a very high rate. The broad middle, that is between 25% and 75%, that is half the counties in the middle, are between 1.25% and 2.1%. So if you're between those rates, you're in the broad middle among all of the counties. So that'll give you a chance, and you know, Tamara and I have started doing this percentile thing for property tax rates and that sort of thing as a way, kind of a shorthand way, rather than having to provide an entire list, a shorthand way of showing, allowing counties to figure out, and taxpayers and then local officials to figure out where they are as far as the whole state is concerned. Well, here's the similar data for the five of the buckets. The certified share public safety and economic development expenditure rates, and then the property tax relief rates, and then the special purpose rates. And it shows you the number of counties that have each. Of course, every county has at least one local income tax rate, at least one part of the bucket there, and so now all 92 have local income taxes. 86 of them have certified shares, and again, that goes back to Cadgett and Coit for the most part, and almost all counties adopted either Cadgett or Coit. So 86 have certified share rates, the average at about 0.8%, and the median at 1%. And you can see the percentiles right there. The maximum rate on certified shares that anybody's got out there is 1.8%, 1.81%, but if you're above 1.3%, you're in the top 9. And there are several counties, 6 of them, that don't have certified share rates. And this probably goes back to the days when, in the old days, there were a few counties that adopted the edit tax, but not Cadgett or Coit. And I suspect those are the folks who don't have the certified share. Public safety rate, you'll notice the median on the public safety is 0.25, and that's also the most common of those rates. And that probably goes back to the public safety Lloyd. That was the maximum rate back then. 0.25 was the most that you could put on that. Now, when I say that the new system has more flexibility than the old system, this is one example of that. Used to be the public safety rate had a 1/4 of 1% limit, but now the public safety rate is included in the great big 2.5% expenditure rate limit. So the public safety rate can now be higher than that. And we see that, in fact, now the maximum rate on public safety is 1%. So several of the counties have taken advantage of the fact that the public safety rate no longer has an individual cap and have increased that rate. So 63 counties now have the public safety rate. 74 counties have the economic development rate, and this goes back to the old edit tax, and a lot of counties did adopt that. Again, median and most common at 0.25, which was the old limit on the edit rate, but now we have a maximum economic development rate of 0.6, and you can see that there are in the percentiles there, the 75th percentile is 0.3 and the 90th percentile 0.5. Property tax relief, 60 counties, about 2/3 of the counties are using some of their lit revenue to reduce property taxes. And there used to be lots of ways to do this. Cadget used to do it. You could do it with COIT. You could do it with EDIT. The Lloyds, some of them were devoted to property tax relief. And when the reform came along, we combined all of those property tax relief ideas into one property tax relief rate. The average rate, about 0.24, the median at 0.136. The most common rate is 0, and we shouldn't make too much of this, but the old Lloyd for relief from the inventory tax shift was a particular property tax relief rate, and it was recalculated every year, and every county had a different rate depending on how much inventory tax was eliminated back in 2007. And so there are a wide variety of quirky tax relief rates out there. And so the most common of all the rates are the 32 counties that don't have it. So that's why you get 0 there for the most common rate. Maximum rate on property tax relief, 1.18%. But if you're above about 0.69, you're providing a lot of property tax relief with your local income tax. And we'll have more to say about how property tax relief works with the local income taxes. Then special purpose, most counties don't have these, 23 of them do. And as you can see, that means that the median rate and the most common rate is 0. So this, again, depends on special legislation for a particular county put into the Indiana Code. Well, here's a map showing you the distribution, the area distribution, the counties that have rates of different levels for the total. The gray is less than 1.25%, and the darkest blue is more than 2.5%. And, to coin a phrase, the rates are all over the map. Not very much in the way of regional patterns that I can see. Two regional patterns you could point out, that is in southwest Indiana, rates tend to be lower. You see a lot of the gray counties in that arc there stretching from Sullivan to Floyd. So relatively low rates in southern Indiana, other than Posey and Perry. Well, Posey's rates are relatively low too, but other than Perry, relatively low rates down there. And then there's that swath of 5 counties stretching from Jasper to Wabash in the northern half of the state, where the rates are particularly high. All of those counties there, Jasper to Wabash, with 2.5% or more. But other than that, you've got some low rates up north, you've got some low rates down south, you've got some high rates up north, you've got some high rates down south. You look around the urban counties, some of the urbans are low, some of the urbans are high. Rural counties, likewise, you've got some low, you've got some high. And so quite a variety across the state. But I put this map up here so you can find your state, or your county, and see where you rank and see what your neighbors are doing.
So, Larry, we might also mention that you can find the rates on the SBA's website. We'll have that at the end of this presentation.
That's
so
right.
if you've got your handouts printed out, that link is on the very last page, or last slide.
Yes, and I'm going to talk about that. There have been a problem in the past with transparency. Why do we receive this amount? Why are our balances what they are? What are our balances in our county's account? I think those problems have been solved. The budget agency is providing a great deal of information now about how this works, and I'll show you the documents and where you can find them at the end of this presentation. Okay, so here was a hypothesis that I had when we made the lit reform. Because we increased the flexibility, lifted a lot of the rate limits, and combined the expenditure rate limits within one great big expenditure limit, that created some flexibility. And also it was a big administrative change in how things worked, and sometimes that gives an incentive to counties to take another look at what they're doing with their local income tax rates. So I thought, with this new change, we would see an increase in activity in making changes in the rates. So I thought we'd look at what the changes were from 2017 to 2018, the first year and the second year under our new lit structure. And you can see the rates. So these are counts of counties doing something. So 7 counties increased the rates for certified shares for the general expenditures under the expenditure bucket. None decreased it. The most activity we saw out there were increases in the public safety rates. 15 counties increased the public safety rate from 2017 to 18. 4 increased economic development. 4 of them decreased the property tax relief rate, and 3 got new special purposes, and 1 special purpose rate probably ran its course. So in total, 18 counties increased their income tax rates, and 1 decreased the rate. Now take a look, you got 4 of them decreasing property tax relief, but only 1 decreasing rates overall, and that tells me that at least 3 counties, and maybe all 4, decreased a property tax relief rate and then shifted their rates to increasing on the expenditure rate. So a little bit reduction in overall property tax relief from the income tax, shifting towards increasing expenditures. So altogether, 19 counties made changes, and so I looked at that and say, well, you know what? Maybe that's true. Maybe the increased flexibility under the new system really did cause more counties to make changes. But if you're going to test this, you better look back at the old system to see what was common in terms of changes every year under the old system. And so I did that, and sure enough, 20 counties made changes between 2015 to 16, which was the last pair of years under the old system. And so hypothesis rejected, I think, Tamara. Thought there would be an increase in activity and rate changes, but maybe not. We had 20 counties making changes between 2015 and 16. And two observations about this chart. Public safety was, again, the most active category of changes. As you see, the public safety rate came under CAGIT. So you see the first 5 rates there are CAGIT rates, so 12 public safety rate changes under CAGIT. And then if you look under COIT, 3 public safety rate changes for COIT counties as well. So 15 altogether, which is exactly the same number as we had from 2017 to 18. So public safety has simply been the most active aspect of both local income tax regimes. The other thing to observe is, as Tamara said, we hope that the new lit system is a simplification. And if you compare this chart to this chart, you'd have to say, yeah, that's a simplification. There are 13 different categories of rates under the old system, and as you can see, only 5, now 6, under the new system. Another way of saying that, yes, I think this really is simplification. In the last year under the old system, the budget agency, when they released their data on certified distributions and rates, it took them, I think, about 12 pages under the old system, and it took them 4 pages under the new system. So simplification, I think you really could say that that's what we have right here. Summing up these changes then, public safety rate, okay, so we said that perhaps in terms of looking at the number of counties making changes, the new flexibility did not seem to create additional activity. But the new flexibility did do a few things, and here's one of them. In 11 counties, the public safety rate is now above 0.25. Now, under the old system, that was not possible. And so we're doing something. 11 counties did something under the new system that they couldn't do under the old system. So the increase in flexibility, having that public safety rate under that larger expenditure total, rate limit did create some changes. As I said, property tax relief was reduced and other rates increased in 4 counties, so at least a little bit shifting away from property tax relief and towards additional expenditures. The expenditure rates increased in 19 counties, and as we mentioned, the total rate increased by an unusual amount in 2018, by more than had been true in the previous couple of years. And so this is probably the result of the increase in the public safety rate above that 0.25%. The question, as I mentioned, is this a blip for the one-time change in the system, or is this a new trend? Will we continuously see bigger increases in income tax rates as we move forward? I kind of think it's a blip, but time will tell, and by October, we will know something when we get all of the changes that happen in the counties with new local income tax rates for 2019. We'll take a look and see whether the increases in the rates add up to more than about 1.5%, which was common prior to the change, or will it be closer to 3 or 4% under the new system. And as I said, most rate changes still to come. The only rate change we've got recorded so far by the budget agency is DeKalb adopting the new county corrections rate for 2019. I looked out at the news coverage of local income taxes, and another, at least a couple of counties out there that may consider this new option as well. Well, okay, let's take a look at distributions and balances. And this is kind of revisiting an issue that has been controversial or problematic, you might say, on and off for the last 35 years. And the question is really, how does the budget agency decide how much revenue to distribute to the counties, and how much will they keep in each county's account as balances? And I thought I would talk about this issue by using one particular county, and I picked Elkhart County. And so I'm picking on Elkhart here, not because Elkhart has done anything unusual with their local income taxes, but rather for a very specific reason, actually. As you probably know, Elkhart County has the most volatile economy of any of our 92 counties. Now, manufacturing, and Elkhart is a very much a manufacturing county, manufacturing is more volatile than other parts of the economy. And by volatile, I mean during expansions, manufacturing activity grows faster than the general economy, and during recessions, manufacturing activity falls more than the general economy. Well, if you rank kinds of manufacturing that are most likely to be affected, I would guess that big ticket luxury goods are the kind of manufacturing that is the most volatile, in the sense that when the economy goes down and people are threatened by unemployment or their incomes are low, I'll bet one of the first things they give up on buying are $200,000 recreational vehicles, and that's what they make in Elkhart. That's the kind of manufacturing they've got there. And so what have we seen? A couple of months ago, or maybe just a month ago, the Wall Street Journal did a special report about Elkhart's booming economy, saying, hey, if manufacturing keeps expanding, the whole world is going to look like Elkhart County, Indiana. And so they were singled out in a national publication as having a booming economy right now. But you may also remember back in 2009, Elkhart's unemployment rate was up at 20%. Those are depression unemployment rates. And President Barack Obama visited Elkhart County to highlight the difficulties that local areas were having with the Great Recession. So Elkhart County, very much a volatile economy. And I put those up here because Elkhart got into trouble under the old systems that we used when their balances in their accounts ran negative, and it happened twice, once after the 2001 recession and once during and after the 2007-2009 Great Recession. And they've had particularly volatile collections, as you can see, declines in collections in 2002, and then declines as well in 2008 and 2009 with the Great Recession. So recessions affecting collections, reducing collections more in Elkhart than in most places, and balances running negative. Okay, so how do we do this? The way that we do this now, the way that the budget agency decides how much to distribute is now based on the previous year's fiscal year collections. So the Department of Revenue does the collections for the local income tax, and this goes all the way back to the original establishment of CAGIT in 1974. The legislature decided not to make each county create its own Department of Revenue to administer the income tax. They said, hey, let's just let the State Department of Revenue administer the income tax. People will pay their local income taxes along with their state income taxes, and then the state will remit in a certified distribution what is collected at the state level back to the counties. So when you see certified distribution, that's the distribution of the state from the DOR, Department of Revenue Collections, back to the county. So how much do you distribute? Well, the way we do it now is we take the fiscal year collections. So for 2018, the certified distributions equal the amount that was collected for each county in fiscal year 2017, which is the second half of 2016 and the first half of 2017. So when you think about it, the amount that's being distributed in any year is based on collections data from 6 months to a year and a half before. So there's this lag. And yes, this means if you're distributing these collections, this means that everything that gets collected for a county eventually gets distributed. But there's a little mathematical quirk that comes to pass in this system and in systems like this when you have a long period of expansion. And we can see that early on in the 1980s. If you are continually distributing what was collected a year and a half ago, it means that your collections are always, if collections are growing, it means that your collections are always running above your distributions. You're distributing based on what happened a year and a half ago, and your collections are what's happening now. If collections continually increase, your distributions will always be below your collections. The difference between distributions and collections go into your balances. And so if we operate on that lagged system with collections always exceeding distributions, your balances will rise and rise and rise and rise. And if you look at that blue line on your screen there in 1984 and 85 and 86 and 87 and 88, balances in Elkhart, and this was true across the state, balances actually grew so much that they exceeded annual distributions. And in fact, they were, in 1984, they were double annual distributions, which means that the state was keeping in Elkhart's account an amount twice, an amount to distribute their ordinary distribution 2 years, even if collections dropped to zero. And the counties looked at this and said, you know, our taxpayers are paying this money in order to see services delivered, in order to pay for local government services, and instead, state, you're holding this enormous amount of money in our balances and not distributing it back to us. And so the state was under pressure, of course, said, well, we'll have to make some special distributions every once in a while to clear out these balances that accumulate because of the lag in distributions and behind collections. And so now, starting in the 90s, every once in a while they would make a distribution. There was a distribution in 1992, and another one in 2002, and another one in 2006 and 2008 for Elkhart County. So that's fine. Okay, so we're going to basically take the balances that accumulate, and we're going to clear it out. And sometimes the budget agency, often the budget agency, would simply look at what balances were at a particular period and distribute them all out to the county. And so every once in a while you get this spike. I think you can see it especially in 2002, this spike in distributions that the locals would receive. Well, that works fine, except when after you've cleared out balances to zero, in the next year a recession hits and collections are less than ordinary distributions. And when that happens, balances go negative. And you can see here's the distributions in 2002, spiking upward above $50 million. And in the very same year, balances going negative because the distributions out of balances were made in a year when the recession of 2001 hit and started to affect collections. and so balances went negative. And this happened again. You can see special distributions going high, spiking upward in 2006 and 2008 at the very time that collections were declining with that recession, and again, balances turned negative. And what happens then is that distributions have to be limited until balances can recover. And take a look at Elkhart's distributions in 2011 and 12 and 13. They were held down under $40 million, whereas previously they'd been above 50, held under $40 million so that they could be held below collections and balances could recover into positive territory. So the system that we had not only created spikes in distributions, that is, collections on the income tax are volatile enough in Elkhart County, but the system that we were using was creating even more volatility in the distributions, the revenues that local governments were actually receiving. But not only that, but balances would occasionally get very large and then would occasionally turn negative. So balances were volatile as well. Well, okay, so the legislature decided let's create a system where perhaps this isn't going to happen. And let me give you a couple of quotes out of the code to show you what they decided to do, or what the code now says. And this says, let me read it to you, the amount that is to be distributed to a county. Now, the important part of this is that there is now in code a system for distributions. For a longest period, for decades, this was kind of ad hoc. Budget agency distributing based on whatever system they happen to put in place administratively, but now it's actually in the code. So here it says, the amount that is to be distributed to a county during an ensuing calendar year equals the amount of tax revenue that the budget agency determines has been, 1, received from that county for a taxable year ending in a calendar year preceding the calendar year in which the determination is made, and 2, reported on an annual return or amended return processed by the department in the state fiscal year ending before July 1 of the calendar year in which the determination is made, as adjusted for refunds of tax made in the state fiscal year. Now, I didn't go to law school, and I got to tell you, it's mental gymnastics for me to try to figure out what it is. And so what I'm going to do here in another couple of slides is take a look at the form that the budget agency uses to crunch the numbers and figure out what this means from that form. But let's go on to another piece of the code. This says lit balances and supplemental distributions, Indiana Code 636915. This tells us about the balances. And this is also a new system in code. It was ad hoc before, but now it is in code. If the budget agency determines that the balance in a county trust account exceeds 15%, that's the key number, of the certified distributions to be made in the county in the determination year, the budget agency shall make a supplemental distribution to the county from the county's trust account. So what this means is that when balances get above 15%, that's the trigger for the budget agency to distribute a special distribution to make sure that balances don't get too large, and they'll distribute, but they'll maintain a balance in the county's account of 15% to guard against recessions when collections fall below distributions. That's the attempt to keep balances from going negative. In May 2018, and the supplemental distributions now go out in May, there were 22 counties that were scheduled to receive supplemental distributions in May 2018. These were calculated based on end of December 2016 balances as a percent of the certified distributions in 2018 as they were published in August 2017. So 22 counties received supplemental distributions because they had balances in excess of 15% of the certified distribution in December 2016. Okay, let's look at some numbers. All right, now here's the form. These are called county informational reports, and you can find them for every county on the state budget agency's website. Now I just put this up here to show you what the form looks like. These numbers are too small to read, but I'll blow them up here in a minute. I show you this to show you that there are 5 boxes on the thing, all the way from the top, which is the collections, the tabulation of what was collected over the previous state fiscal year, all the way down to the bottom, which is the calculation of the balance and the supplemental distribution. So let's look at the top box here. This is all for Elkhart, all for 2018. And so the first box says process collections for July 1/16 through June 30th, 2017. So that's the state fiscal year 2017. And remember, this whole form is about answering the question, how much are we going to distribute in 2018 to Elkhart County? And so we go back to 2017 fiscal year, and they've got two boxes there that tell us that in the first half of that fiscal year, which is the second half of 2016, a little less than $8 million were collected, and in the first half of 2017, calendar 2017, which is the last part of fiscal 2017, 94 million were collected. And you'd expect that, right? The deadline for income taxes is April 15th. That's when people actually remit their income taxes, so that's when the money is received. In total, $102 million. So remember that number, $102 million processed collections by the budget agency, by the DOR, Department of Revenue, from fiscal year 2017. The next part allows for adjustments to that number. And you can see there are four of them here in this box, and they're all zero for Elkhart. So let's just take a look at what sorts of things could be done by the budget agency. If you've got a negative balance, well, you've got to have a limit on the amount that's going to be distributed. You want to limit it below the total amount of collections. And so with a negative balance, that number would be negative, a negative adjustment from collections, so the distribution will be lower. The code there, 3.69-6 and 7 and 8, the form actually hasn't been updated. The code sites that are on the form are different than this, but they are actually citing parts of the code that have been repealed. So the new site should be these here. The budget agency has discretion on how to do this. They're not required to adjust the negative balance all in one year. They can spread it out over several years so that a county doesn't have to make up their entire negative balance with a big shortfall, a big reduction in distributions in one year. But the budget agency does have discretion on this. Adjustment for clerical and mathematical errors, you might think that's a sort of little quirky thing that might happen every once in a while, but we can recall a period just a few years ago where a very big mistake was made and a very big adjustment was made in the distributions to counties. This can also be a problem in that the budget agency will tell you, here's your certified distribution. Yes, it's certified. Yes, you can distribute it. Yes, you can spend it. And then, oops, nope, that was a mistake. We're going to have to make an adjustment the next year. And one hopes that doesn't happen very often. But that's where, if that was going to happen, that's where that would show up. Then the last two boxes are for rate changes. And so if you make a rate change, that would not have been included in the previous fiscal year's collections, but the budget agency will make an estimate as to how much that additional rate will bring and increase your distribution for the rate in the year that it is adopted. So you don't have to wait for an entire year before you actually see the additional revenue from that rate. So for initial imposition for rates for expenditures, initial imposition for rates for homestead credits and property tax relief. Next is the distribution, certified distribution, and how it divides up into the buckets. And you see the 5 buckets here, and they're going to have to add another bucket for the corrections, county corrections rate. And there's certified shares, public safety, economic development, the property tax relief number, and the special purpose number, all for Elkhart, adding up, as you see, to $102 million. And so that means that what was collected in the previous fiscal year is distributed to the counties in 2018. And so this has always been, or historically has been, a concern of the counties that all the money that gets collected actually gets distributed. And so here is the budget agency being transparent, saying, yes, this is the amount that the DOR tabulated as having been collected for the counties, and yes, the next year we are going to distribute it. The next box here shows the same categories and shows the property tax rates, and so I won't give you that box as well. And we'll move on to the last box, which is the balance and the special distribution calculation. So calculation of excess balance. And so that's what we do. The special distributions above the certified distribution will be based on excess balances above 15%. So estimated account balance on December 31st, 2016, Elkhart, growing collections, rapidly growing collections with their booming economy, and their balances at $18,761,000. Well, that balance, as you'll see in the red below, the certified distribution for 2018 was $102 million, so 18.7 million of $102 million, that's 18.4%. That's the key percentage. And so as you can see, the years don't match up there. You're matching the December 16 balance with the 2018 distribution, but nonetheless, it's 18.4%, and that's above 15%. And so the number there, $3,445,000, is the amount that, if you distribute it, will leave $15.3 million in Elkhart County account, which is 15% of the certified distribution. I looked at all the data for all the counties on these informational reports, and sure enough, for all 20 of the 22 counties, I should say, the supplemental distribution reduces balances to 15%. Now, there were a couple of counties where the balances were left higher than that, and it looked to me like they're putting a 30% limit. The two counties that were different had balances very large, upwards approaching 50%. And so it looked like they didn't distribute all the way down to 15%, and maybe they're going to do that over a couple of years. So that may be also smoothing out the special distributions. But nonetheless, for most of the counties, the rules that we see in the code are being followed in this table on this informational report. You can see exactly why the special distribution is what it is, what your balances will be, what your collections are, what your distributions are, and how those are calculated. So I think a very nice informational report, making a process that in the past has been rather obscure, making it pretty transparent now so counties can see how it's done. How is this going to work? Will this new system, this 15%, this, what is the new system? The new system is looking back at the fiscal year collections in order to determine the distributions, looking at the balances and distributing as special distributions those that are above 15%. How is this going to work? So what I did was to take Elkhart's collections, right, and that's what's coming in, and that's based on economic activity and tax payments by the folks who live in Elkhart, looking at those collections and saying, suppose we had used this system, the one I just described, starting in 1984 and running all the way through 2016. And you'll notice these are Paget collections, and so 2016 was the last year under the old system. So suppose we had done that. What would distributions and balances have looked like in this most volatile of our counties? And here it is. Had we been following this system, here's what it looked like. And what do you see? You see balances always less than distributions. And so balances don't get unusually large. You see balances negative in only 1 year and then only slightly negative. And this tells me that if the 15% balance rule can keep Elkhart positive territory, it's going to keep everybody in positive territory. And that's the reason to look at Elkhart. If Elkhart's balances are staying positive most of the time, then everybody's balances are going to stay positive most of the time as we get into this system. It also shows distributions. If you compare that dotted line here, here's what it used to look like. Here's what it looks like now under this new system. Distributions much closer to collections, which means they reflect the volatility of collections, but the system itself is not adding to volatility. And so distributions probably more predictable, smoother than they were as we move forward. It seems to me the system ought to work, but we won't really know, will we, until the next recession comes along. And so let's hope we don't find out whether this is going to work in recession for a long, long time. And just looking at the economy now, I don't see a recession on the horizon. There's always uncertainty, of course, and economists now think, most economists think that recessions are caused by shocks, and shocks are by their very nature shocking. And so we don't know when the shocks will arrive, but I don't see anything systematic or particularly shocking on the horizon that might be big enough to cause a recession. So let's hope that's true, in which case, if we have several years of expansion to run, the whole system, we can get the whole system into this new rule and this new process, and with any luck have balances high enough so that when the next recession hits, nobody has to go negative. Here's what balances are now, and as it turns out, there are 10 counties that have negative balances. So what you see here is a map of the estimated balances at the end of 2017. So these aren't official yet. We won't know the official ones till the second half of this year when the budget agency does that calculation. But they did do a preliminary calculation for the end of 2017. And so we see that there are 10 counties, and they're colored red there, that have negative balances. Now, I looked to try to see what was going on here, and several of these counties had old-style special distributions. That is, the budget agency looked at balances and basically cleared them out, distributed them out to the counties, and then collections were less than distributions, certified distributions, in the next year, and that created negative balances. Under the new system, this shouldn't happen, and so as we move forward, one expects that the number of red counties, the number of counties with negative balances, should diminish and within a few years disappear. You see as well a lot more counties, fortunately, since the economy has been expanding, with balances more than 15%. And so those are the counties where one would expect in 2019 to see special distributions of some amount or other. And so we should see those balances cleared out down to 15% in those dark green counties right there. For the less than zero, of course, we should see an entry into that category on the informational form, which is adjustment for negative balances. So their certified distributions probably be limited for a year or two or three in order to get those balances back up positive. So we'll see. You know, it's a little bit concerning that there are so many counties with balances less than 15% under the system that we've established now, and counties that are expanding, where their collections are going up year after year, should wind up with 15% or more, and you know, being set back down to 15% balances with special distributions. And so the fact that we see about a third of the counties out there with, or maybe more, maybe half the counties with balances under 15%, I think, I expect, I hope, is still a legacy of the old way of doing things, and under the new way, we'll see balances above 15%. But time will tell, and that's certainly worth watching. All right, lastly, let's take a look at property tax relief. And this is where the local income tax intersects the property tax, and I thought it was worth talking about how this is done. And so let's take a look. There's an awful lot of discretion that counties have on how to distribute property tax relief out of the local income tax. So what you do is you adopt a local income tax rate, and the rate can go up to 1 1/4%. And then you say, how do we want to distribute this relief? That is, who gets the property tax relief? And the relief, property tax relief, is credits, that is percentage reductions to people's property tax bills. And here are the 4 official categories of property tax relief that counties can use. They could give the property tax relief to homesteads, and those are the ones that are eligible for the 1% tax cap or circuit breaker credits. So the 1% counties, or 1% category, those are all homesteads, and so the county could, if they wanted to, take the revenue that is collected from the property tax relief rate and distribute the tax relief entirely to homesteads or partially to homesteads. Excuse me. They could distribute it to residential property, long-term care property, and agricultural land. That's the 2% tax cap credit category. So they could, if they wanted to, take that revenue from LIT, from the property tax relief LIT rate, and distribute it to those categories there. So that is mostly rental housing, second homes, vacation homes, retirement communities, and also agricultural land. That's what's in the 2% category. Or they could distribute some of it to homesteads and some of it to the second category. There's a third category here as a single category, the non-homestead residential property, including residential and commercial rental housing. So that's basically category 2 plus homesteads, not counting ag land. And so that's a legacy from the old system, this particular category. And then the fourth category is the 3% tax cap credit category, which is basically business, land, buildings, and business equipment in the 3% category. Now, you could distribute all of the revenue, all of the relief to one of these, or you could give half to one, a half to another, or 1/3 to one, 1/3 to another, 1/3 to another, or 1/4 to all four, or any possible combination. Now, only a few counties have really gone in and tried to adjust things one and the other. Most of them either give it to one or to two categories, but nonetheless, great deal of flexibility as to who gets the local income tax, property tax credits. Here's the total relief rates that are out there, and as you can see, I think we had 62 counties have used local income taxes, at least partly, for property tax relief. There are a few counties that give quite a bit of property tax relief, and in fact, if you look there, you can see that swath of counties up north with the high rates. Their rates are high in part because they give so much property tax relief. So they're not just raising income taxes in order to deliver more revenue for their local governments, they're also using that to give property tax relief, essentially to shift their local income tax revenues from property to income. Down south in the southwest there, you can see that there are relatively low property tax relief income tax rates in several of those counties, and then many of them that don't do it at all. So one of the reasons their rates are so low down there, their income tax rates are so low down in the southwest, is because they're not using the income tax for property tax relief quite as much as in other places. But as you can see, in general, more counties have rates between 1/4% and 0.75% than any other category, but once again, all over the map as far as property tax relief lit rates. Here's, now, what I wanted to do is give you an example of how this is done. How do we start with a lit rate and wind up with tax bill credits, the percentage on the bill? And I thought we'd use Park County here from 2017. I haven't done the calculations for 18 yet, so we'll use an old rate, but this will give you an example as to how this works. And this is a table that came out of our seminars that we do across the state, and we've been doing for several years now, called How the Property Tax Works in Indiana. So some of you may have attended those or heard about those, and if not, we'll be in your area sometime within the next few years. We've been doing this, what, for 3 or 4 years now, Tamara? Is it longer than that?
3 years.
3 years.
Have covered the entire state this August.
By this August, we'll have done at least one regional meeting that covers every county in Indiana. And so then we'll start another round after that. But okay, so Park County, how does Park County do it? How do we calculate the things? Park County has a property tax relief lit rate of 1/2 of 1%. That is, they have tacked on as part of their lit rate a 1/2 of 1% rate to raise revenue for property tax relief, and that rate in Park County raises $1,337,003, or at least that was the distribution that the state made from the collections from fiscal year 2016 for property tax relief. So we take that $1.3 million, and what do we do with it? Well, the county council looked at this and said, I know how we're going to do it. We're going to give about half of all of that property tax relief to homesteads, that is that number 1 category, and we're going to give half across the board, and that's an acronym PTRC. That's Property Tax Relief Credits, Property Tax Reduction Credits. And that's a very old term, PTRC, that goes all the way back to the original Cadget tax. And you'll notice that wasn't included in the code as one of the categories. The 4 categories that are in the code are homesteads, the 1%, the rental farmland 2%, the business, real, and personal 3%, and then this non-homestead residential category. This is not in the code, and yet the budget agency, and in particular the DLGF, the Department of Local Government Finance, I think as a kind of favor to the counties, allows you to do this, allows you to say, we want to provide property tax relief across the board in an equal credit percentage to all of our taxpayers. Now, if you wanted to do that using the 1%, 2%, 3%, you could adopt, for example, an equal rate or an equal distribution, relief allocation to the homesteads, the rental, and farmland, the 2% category, and the business, real, and personal category, 3%. If you wanted to do that and get equal percentages, what you'd have to do is say, well, how much do homesteads pay in property taxes? How much do farmland and rentals pay? What does business pay? And we'll set the relief allocation equal to those percentages, and that will give equal relief to everyone. Well, if that's how you were going to do it, you'd have to change the allocation every year to equal the changing nature of the property tax payments and the assessed values, and that would be hard to do. You'd have to be acting all the time. So instead, basically, the DLGF does that for you. If you essentially tell them we would like equal distribution or equal relief to everybody, they will do that calculation for you. Even though that's not in the code, that seems to be what's going on. So Park County says half of it to everybody across the board, half of it just to homesteads. And so we took half of the amount, the $1.3 million, and said we're going to allocate that to relief for all property, and we took half and allocated it in relief to homesteads. Now, when I did the sort of backwards calculation to figure out what the relief allocation is, I got 49 and 51. I suspect they really just do it 50-50, but when you try to reverse engineer the numbers, that's what it comes up as. But basically 50-50. Okay, so then what do you do? And then the last part of this table, you say, all right, what's the property tax levy? Well, all property pays $10.7 million in property tax. Out of that amount, homesteads pay $1.8 million. And so we take the all property lit relief allocation of $658,000 and divide it by the $10.7 million, and that comes out to be 5.9%. So all property tax bills get a reduction of 5.9%. And then homesteads, we take that $678,000 and divide it by the 1.8 million. Well, that's a much smaller base. And so basically that's an additional 35.8% homestead tax bill credit for the homestead. So if you adopt just 1% and say our property tax relief money is going to go for homesteads, or just one of the categories, the base the levy that the one category pays is smaller than the total, and you can get very large tax bill credit percentages. And so in Park County, homesteads receive a 35.8% tax bill credit, and they also get the near 6% credit. So in total, that's about 41% reduction in the tax bills of homesteads. So quite a reduction for homesteads in property taxes, but of course they're all paying that extra 0.5% income tax rate. You know, how you get distributed and who wins on net and who loses on net is very much a county by county calculation based on what's the rate, what's their incomes, what's the assessed value, what's their property tax payments, and what's the allocation of relief that the county has voted for. But that's how you do it. That's how you start from the lit rate at the beginning and move all the way to the tax bill credit percent that shows up on your tax bill at the end of it. Well, here's what the credits look like, and what I've done here is put together a table for PTRC and then the other 4 official categories, the code categories of the 1%, 2%, 3%, and then the homestead other residential category. And these are the credit rates that show up on the tax bills, that is, the percentage reductions in the tax bills for property of that particular type. And so we've got 0 to 5%, 5 to 10, 10 to 25, and then more than 25%. And you can see on the Park County rate how you can get a rate credit upwards above 25%. If you distribute the tax relief narrowly, then you can get a very large percentage reduction on the tax bills.
I think Montgomery County is like 74, 75%.
You can knock out a very large share of the tax bill if you distribute, you know, if you adopt a 1/4 or 1/2 or 0.75 or even a 1% lit rate for property tax relief and then devote it all to one category, to homesteads in particular, you can reduce their percentages, their tax bills by quite a bit. You can see how it's distributed. As you can see, PTRC across the board and homesteads 1% are by far the most common of the distributions. 61 counties have at least one lit property tax credit rate. and 24 counties divided up into more than one. And so the most common combination is homesteads plus PTRC, like Park County does it. But as you can see, homesteads, other residential, we've got 10 counties with that as well. And so a number of counties do that. The distributing it just to 2% or just to 3%, as you can see, that's very rare. Even in combination with other kinds of property tax relief, those haven't been popular categories. All right, well, that's what we have to say about LIT. That's shedding light on LIT. But let me show you the source of information for most of this. And here are the documents that you can find on the budget agency's website. Now, you might think you'd go to DLGF to get this information. You might think you'd even go to the Department of Revenue to get this information. But no, that's not right. You go to the state budget agency. And this is a historical thing. Way back when we decided that we were going to allow the state to figure out the revenue collections, to do the collecting of local income tax revenues, and we were going to allow the state to figure out how much is to be distributed. They said, well, who should do this job? And they said, oh, budget agency, you're the ones with experience in predicting what income taxes are going to be, because they do it for the state. So you do that as well for the locals, and ever since then, the budget agency has been in charge of this. And so what can you find on the budget agency's website? And you can see the URL, the address down at the bottom there. You can find the estimated certified distributions. This is the document for 2019 that was placed up on June 1st. And all the counties, or at least the people in the counties that worry about revenues get pretty excited when these numbers are posted. So there they are. They're available now. And that's the one that shows a pretty sizable increase this year, the 8.3% average increase across all of the counties. You can also find the 2018 and before actual certified distributions, so that's the total amount that's actually being distributed. You can find the actual 2016 and estimated 2017 local income tax balances. So that's the indication of where balances are accumulating and where they're negative. So you can get indication as to who's going to get special distributions in the near future and who's going to get some restrictions on their distributions because their balances are negative. You can get the trust balance history, the collections and distributions and balances back to 1999 and all the way up to 2016. Now, these forms are going to have to see some adjustments because they are for each individual income tax for every county. So you've got CAGIT, you've got COIT, you've got EDIT documents. And so as we move to 2017, some changes will be made. I hope we don't lose that old information when we move to the new information. In fact, there is some information that was locked in the, I have information going back to the 1980s on these trust balances history, but what's available now is only back through 1999. And then the individual county information reports, and you have to look for that, link on the budget agency website. When you click on county information reports, you'll see information report for every county. And that's the calculation of distributions for 2018. So you can see what were the collections, what are the balances, what are the special distributions going to be here in 2018. And there's the website on the in.gov and SBA. And then the way the state does it, they don't use names anymore for their particular documents. They've got them numbered, but 2587 is the one that you need to look at to see the list of links that the budget agency has for local income taxes. Well, that's shedding light on LIT. Tamara, I think we'll take a break.
Yeah, we'll take a short 5-minute break, and we'll be back at 12:24.
And so questions, right? If you do have questions.
If you've got questions, feel free to post them in the chat box. You also can unmute yourself if you'd like when we come back from the break.
Okay, we're back after a rather embarrassing episode of not understanding technology, both in not muting our microphone and not understanding how telephones work now. In order not to receive a phone call, I had lifted the receiver off the cradle, figuring that would mean it wouldn't ring, and then it rang. And then it stopped ringing, and apparently the phone call continued. And the gentleman who had called me was able to listen to what we were saying over the phone. So
and ended up joining us. So I guess that was,
I have an excuse. I'm approaching senior citizen status, but.
Well, my excuse is I have not had a landline, office or otherwise, in probably
well,
4 years. So
there you go. So. In fact, I don't have an excuse since I still do have landline in my office and at home as well, but apparently telephones have outpaced my knowledge of technology.
Well, so, and many people have texted or emailed asking for the M&M, so we will have to bring those to the next regional workshop.
I guess, that's right. As they say, did you bring enough for everyone? And, and we haven't got to the point where you can actually send M&Ms as attachments over email, but when we can, we will certainly do that, yes.
Okay, so.
We also have that reference right out there.
Oh, so another funny little quip. I did not realize it was Prince's 60th birthday when I referenced the artist formerly known as Prince, but.
A great loss to the music world, but happy birthday to Prince.
And thank you to Jasper County for pointing that out.
Absolutely.
So Celia asked, how can you find out your county's lit rate? And that was early on. I shared the 2019 link in the chat box, the estimations, and Larry showed you where you can find all of that information on the budget agency's website.
And that's a relatively new thing. In just the last few years, early on, the budget agency, when they would publish the certified distributions, only gave the revenue numbers. But now they give the rates as well. So you can find the rates and the revenue numbers on the certified distribution document.
Next, we have a question from Bartholomew County. Might a possible use of lit property tax credits be raising the upper valuation limit to the 65 plus property tax deduction, or must the relief be spread evenly across all properties? Well, it certainly doesn't have to be spread evenly across all properties, as we showed the different categories. You can distribute some to homesteads, some to all property, or some to the 2% or 3% category. But the 65 plus, I mean, you can't distribute it just to the 65 plus category.
Within each of those categories, it's equal.
Yeah.
And the code actually says that's explicitly that it has to be equal within each of these categories.
And that is a little bit of a change from the inventory tax days. There were some counties that still had different rates for each taxing district, or different relief rates. So a homestead credit would reduce the valuation, or would give credit to that 65 plus category. That's not a huge percentage of tax cap credits, but 65 plus. And it's also important to remember, and this has happened in a few places, that if you give them so much, if you give so much property tax relief that you reduce their bill to zero.
And this is people over age 65 that are eligible for that particular tax cap or tax credit.
Then their tax bill will remain zero for the rest of their stay in that house.
That's right.
Because that tax cap credit is based on, it can only increase by a certain percentage each year.
The tax bill that you pay on your house can rise only as much as 2%. And if you go from zero to positive number, that's an infinite increase, and so
you can't have that.
It wouldn't happen. So if you're over 65 and you meet the income limits on that credit, and you were ever once reduced to zero, you will forever be at zero.
Mm-hmm. Do the special distribution funds, and this is from Washington County, to township trustees have to go to the rainy day fund? And so if you recall, this is that certified share portion of the expenditures. They also may receive some funding from property tax relief rates. Yeah,
the special distribution, and that's the thing that comes out in May if your balances move above 15%. Code says got to go into the rainy day fund. And maybe the question is, if you don't have a rainy day fund, where does it go? And I guess my guess is, well, you'd better set up a rainy day fund in order to receive it. But the code actually does say has to go into the rainy day fund.
It looks like the link for the 2019 estimates isn't working. I will send that out afterwards to everybody.
Yeah, well, and let's face it, those numbers are going to be revised.
Yes.
This really is an estimate. We've still got a whole month of fiscal year that will change those numbers, and they're going to get all of the changes in tax rates. So one would expect to see documents, revisions in that document or new documents popping up from now until basically the end of the calendar year. And so I don't know whether their website is just not working or whether the document's been taken down and is going to be replaced with something else. That's certainly possible as well. But we downloaded it, and so we've got it, and we can send it to you.
Well, in truth be told, I shared that on the chat. You're in front of the keyboard, so I don't have access to the keyboard. And so what I did was have somebody, I texted somebody to put that into the chat privately to me so I could share it. So it could have, something could have gotten lost in the translation.
Could be. Yeah.
Steve Klink asks, in counties with higher tax cap rates, what is the effect of LIT has on government unit revenues, winners and losers? Do school property tax supported funds do better in this scenario?
Yes, they do. So this is the interaction between LIT property tax relief and the tax caps. And as I'm sure you know, the existence of these tax caps throws a wrench into just about everything we do. It's like TIF in a way. TIF does this as well. But whenever you think about what's happening with income taxes, property taxes, budgets, you always got to look at the tax caps. So the key thing here is the tax caps are applied at the very end of the tax bill. So everything else that happens to your tax bill happens before we look at the tax cap comparison. That is, we look at what your tax bill is compared to what its cap is. And so if you're a homeowner, the cap of 1% of the gross assessed value of your property, that is the assessed value the assessor puts on your property before deductions, that's your cap. And at the end of the process of calculating all credits and all deductions and everything, whatever your tax bill is, that's what's compared to the cap. So if you adopt a local income tax for property tax relief, it reduces everybody's tax bill. And that means that some people who would have been eligible for a tax cap credit, whose tax bill would have come in above the cap, now does not come in above the cap. And so those that tax cap credit break for taxpayers doesn't take place. And of course, if it's a tax break for taxpayers, it's also revenue lost for local governments. And so that local government revenue loss doesn't take place. But of course, there's a different credit. It's the LIT credit has, in a sense, replaced the cap credit. But the LIT credit is funded in the sense that the revenue that is not paid in property taxes is replaced with local income taxes. And that's how we distribute the local income tax revenue to local governments. We simply say, how much did you lose on that credit from the property tax? Yes, that's the amount you'll get from the local income tax. Well, schools lose revenue from the tax caps, and so they get revenue replaced from the local income tax. So even though officially there's hardly any revenue that goes to schools from the income tax, by adopting a LIT credit, you reduce the tax cap losses to all local units, and schools therefore collect a bigger share of their property tax levy because the income tax has replaced some of that levy. And so yes, in a sense, schools do share it. Now there's another place where schools share in LIT revenue, and this is again a legacy of CAGIT. Back in the day, a small piece of CAGIT was actually distributed to schools meant for property tax relief, but it showed up in school budgets as income tax. And so now that schools are not included at all in the expenditure category, if you were a CAGIT county, some of the LIT revenue still goes to schools. They were held harmless by the reform.
Edra had something to add about the rainy day. She says the special distribution goes wherever the rest of LIT goes now. That's a recent change.
Oh, good. Okay. I didn't realize that. Yeah.
Unlike previous supplemental distributions, the supplemental distribution does not have to be deposited into the taxing unit's rainy day fund. Each taxing unit will deposit their supplemental distribution into the local fund in accordance how the funds were originally generated.
Okay. Oh, we got a long answer. For example, oh, you go ahead.
For example, CAGIT certified shares, CDIT certified shares, and COIT certified shares will be deposited into the same fund where the unit is currently depositing their certified shares. So this is the old system, but looking at the new.
Okay. Well, there you go. That's a better answer than the one I had there. So At one time, it did say something about we're going to put it in rainy day funds, but now, every local unit has a fund for the local income taxes. So that's where it's going to go, and that makes a lot of sense, I think.
And so Edra also shared, this is from the most recent memo. Oh, somebody else.
Oh, there it is. Okay, Fred Van Dorp, yes, has put it out in a memo. So 2018 memos, that makes me feel a little better in that I don't continuously read all the memos from Budget Agency and DLGF. So there's a new memo that says not rainy day fund, deposited into the local income tax fund.
And Edra or Letitia, if you want to send me that memo, I will send that out with the recording so you guys can all have it.
That would be great.
They cut and pasted that from the memo. Very good.
Oh, oh good. That was a very long thing to type there.
I think the one thing, and I don't know, is that I had thought about was fire territories. And, I'm always kind of interested in this whole fire territory, fire district, township fire protection. And a lot of the townships don't receive, or as far as I know, not very many townships receive public safety lit money that primarily goes to, or that really goes to counties, cities, and towns unless they adopt for it to go to townships for fire. So I'm curious, when you have a fire territory that includes a city, and I'm thinking, I think Delphi is like that, is having Delphi, the city, hold that money for the fire territory or do the budgeting through the city, would they be able to use lit public safety for essentially township fire protection?
Oh, that's a good question. And I don't know the answer to that. Certainly my impression is that the point of view out there in the state is that a fire territory is really part of the city. If the city's established a fire territory, this is kind of city budget. You don't think that? No,
because we definitely have fire territories that are between townships without
between townships, yeah. So in talking to people, they often will talk about the fire protection, even if it's a fire territory, as if it was something the city was doing.
Sure.
But that doesn't matter. I mean, what matters is what's in the code, and I don't know the answer to that question as to how the money is distributed and whether you can use it, even if the county or the lit council hasn't said explicitly that public safety money can go to fire districts. Well,
so this brought up another question that I had, because it doesn't specifically list townships, so you have to wonder about schools too, and actually Steve Klink apparently had the same question that I had with all this talk about school safety. Could those public safety collections be allocated to school safety or school resource officers?
There's an awful lot of, well, let's put it this way, interlocal agreements allow you to do just about anything with your money.
True.
Right? And, the public safety officer in a school building is, as far as I know, usually a sheriff employee or a city police, town police employee. And so one could easily imagine the city saying, we're going to take some of our public safety money and fund another public safety officer whose duty it will be to police the school. And that sounds plausible to me, but again.
But there are other public safety aspects for schools that would not necessarily come out of.
Could you pay for metal detectors, thank you, at the entrance of a school building with this money? And that sounds more like a school expenditure, and then I suspect the answer would be no, you couldn't do that. Although, of course, the city could buy them and install them, presumably, in school territory if the city wanted to do it out of their own budget. So, I suspect that a determined group of local governments could get it done if they wanted to, but it's not the sort of thing that could happen automatically under the lit code.
So I think what this shows, and we saw this originally in kind of what happened with our last local option income tax system, was people got very creative with how they used economic development and public safety and the different various rates, to the point where the legislature said we need to have a simplified system in this certified shares category that's more general. And so I think that this is kind of the same thing that's happening, is there's a lot of creative things that you can do, and I think local governments will continue to find those creative avenues if this is something they feel like they need to fund.
I tend to see that as a positive thing. Of course, there's got to be limits, and we need to police what local governments do, and you want to avoid illegal activity and fraud and all that stuff. But if you got too much one-size-fits-all, then things that a local community needs to do, wants to do, might be disallowed. And one can think of an awful lot of positive, useful things that local governments might want to do that you wouldn't want restricted. And I think we've seen this especially, or in particular, with fire protection. There's got to be at least a dozen different ways of organizing fire protection in the state of Indiana. And while one might look out there and call it a crazy quilt or a hodgepodge, on the other hand, it means local communities are creating something that works for them. Why not?
Yes, so more to research, more to learn about.
Absolutely. Peeling away the layers on the onion, or eating through the parfait.
Oh, I like that reference.
However you like the layers. There's no end to it. There's always something new to learn.
Just a few housekeeping things. I will send out the recording hopefully tomorrow. I'll be able to get that out. And with that will come a survey. Please take the survey. That's how we pick topics. This one came straight from some suggestions from one of the prior webinars. And so please take that survey to help us out. Also, we don't quite have the next On Local Government webinar date set, but we do, and I will be sending this out, have saved the dates for a couple of local government finance workshops. Some of our regional workshops will be in Blackford County, in East Central Indiana, August 15th, and Warwick County. Maybe the person from Warwick County on can remind me when that is. I believe it's October 26th, but I will send that out with the recording. And finally, we are on Twitter. We are over 800 followers, as I'm sure Larry has.
815, I think, was the most recent count.
And so at IN Tax Rockstars, you can see that on the PowerPoint on the slide. Please, if you are a person that is on Twitter, please follow us, tweet us questions.
We've had a couple of conversations on Twitter, but we also post the dates of the things that we do on Twitter as well, so you can keep track of us that way too. And we have some fun with it as well.
Yes. So thank you very much.
All right, I guess that's it. And thanks for listening, and have a great rest of your day.